Hello and welcome. I'm Andrew from Money 101. I'm delighted to be joined today by Simon Russell, Director of Behavioural Finance Australia. Welcome, Simon.
Thanks for having me.
So Simon, the end of the year is fast approaching now, and for many of us, we're starting to plan for the Christmas period. If we're ordering presents from overseas, though, we might actually be lucky to get them on time this year. That's because of an ongoing crisis that's happening in global shipping. We know there are several factors at work here. Can you tell us a little bit about what's happening?
Yeah, sure. I mean, if you go back to basic economics 101, I think you can look at supply and demand. So, I mean, what's happening from a demand perspective, and not just us here in Australia, but globally, or at least in a lot of countries, we're in a position where we've been, as consumers, flooded with stimulus payments, checks from the governments, we might call JobKeeper or Job Seeker or whatever. That sort of stuff. We've been flooded with monetary stimulus, so interest rates are nice and low. So effectively, we're all flushed with cash, but nowhere to go. So possibly until recently, if you look at consumer spending generally in developed countries, we've got goods and services, and the mix of goods and services historically has been, looking at major economies, tending to be in favor of services over goods, but we just haven't been able to spend as much on services. So we've got all this money, can't spend it on services, and so some of it is being directed into more goods. So effectively, we're demanding more stuff. While we've been stuck at home, we've been buying more stuff. And so we're, from a demand perspective, trying to pull through the supply chain just a bigger number of things than historically we would have. So that's happening from a demand perspective. Then on the supply side, it might be okay if we tried to pull more things. Probably still wouldn't be okay. It might be okay, though, if we tried to pull more things through a supply chain. But we've then got disruptions that have happened, and there's a whole hit list of those, which I'm sure you're aware of. And some of them have been well publicized, like the Ever Given, the shipping, the container ship that was stuck in the Suez Canal that banked up for a few days, and there was sort of billions and billions of dollars of supply that got stuck behind it. I think some of the ships had to go then around the bottom of Africa to get past. So I mean, there's just been a hit of those things. So we've had that, the disruption at ports. You've got the sort of coronavirus, furloughing and quarantining of people actually on the ships and in the ports. So if you look at major shipping ports now, like off the coast of California, you've got literally dozens of these container ships just parked off the coast, and they're waiting for a berth to be able to come and unload the containers that have, in that case, come from China. So it's effectively, I think in that case, roughly doubling the time it's taking to ship from, say, China over to the US in that case, because half the time you're sitting there just waiting to unload. So that's, I guess, shipping. And then that's just the ship part. I mean, then you've got to get into the port, you've got to unload, and then you've got shortage of containers, for example, and then it has to be put on a truck. And we've got difficulties. Look at the UK, where we can't just get enough truck drivers, for example, to go around, and in that case with fuel. So sort of there's a knock-on effect through different parts of the supply chain, and even planes as well. I mean, there's not as much goes through the flights as does the ships, but again, there's not as many planes in the air that we can't then use for that aspect of supply as well. Yeah, so there's a bunch of things, I think, as you say, contributing to that as well.
It's interesting they mentioned the Ever Given. So it was estimated around 12% of the world's shipping travels through that canal, and that those 6 days doesn't sound like a lot, but as you say, hundreds of ships ended up backed up at the canal. And then you have, when it was finally cleared, the blockage, I think it was estimated around $10 billion worth of global shipping was all arriving at its destination at the same time, causing that backup and really playing havoc with a system that was already, as you say, affected by COVID. You had those passenger flights that do carry some freight on board. We might not think about it when we actually get on those planes, but there's freight apparently in the bellies of those planes, and that was really given a hit by the pandemic as well. So it's a bit of a perfect storm almost, isn't it, to put all these things together.
Yeah, I mean, it's bad news for anybody who is looking for those containers to arrive and unload. It's good news if you're owning a ship, though. I mean, that's effectively, if you're an owner of a ship and you're hiring out these ships, and then what's happening? Well, they're stuck at a port somewhere. You're just earning more and more money. And meanwhile, there's more and more demand for ships, because not only we need them to go back and forth between ports, but we need them to sit off the coast for a while as well. yeah, so it's not all downside. I mean, admittedly, it's a large downside because it's sort of the flow-on effects through the economy. But as a ship owner, and that's, I guess, I mean, there's several of those sort of companies, and shareholders of those companies have actually done quite well out of that.
Well, it's always the way, isn't it, that even when a downturn, there's opportunities available out there for certain investors and certain companies, and I guess that's no different in this case. So we've also seen a bit of an e-commerce boom in Australia, haven't we? That Australia Post is having to deliver, I saw, around 10 million parcels across Australia a week, and that volume was only seen previously during Christmas season. So there's clearly a bit of give and take. As you say, people are more cashed up, and they'd have nowhere to go in terms of overseas holidays, so they're spending it on consumer goods and doing up their houses or whatever else.
Yeah, I mean, arguably, to some extent, these trends have accelerated what was already in train. I mean, because if you look back, well, I don't know, 10 years or more maybe, and what was Australia Post doing? Well, they were largely delivering letters. And how many letters do you receive now? Very, very few. How many parcels do you get? I mean, they come all the time now, don't they? So has that just been a pandemic related thing? The fact that I can't go to the shop because we're stuck inside until the lockdown passes? Maybe to some extent, but also maybe that was just a trend that existed already. And frankly, Australia's a long way behind when you look at the percentage of our consumer spending, which is done online, compared with other major economies around the world. It's still a small fraction. So possibly a long way to go. It
was interesting as well, sort of contributing to that slowdown, I guess, in deliveries. We've had some strikes recently. The Maritime Union, Star Trek, FedEx even recently have gone on strike. And I know just from anecdotal evidence that people have struggled to get things delivered on time. There's an issue with, as you say, in Europe, in the UK, but also here, I understand as well, but couriers and truck drivers, getting hold of them. Even things like, Australia Post staff in Victoria having to go into isolation during COVID, and all of that has led to a bit of a backlog now, which I guess is sort of contrary to that expectations that consumers now have, that an order will be delivered quickly, that they click something online and that they expect to see it at their door pretty soon. But that's not always the case, not always the reality, I suppose.
No, and I think that highlights perhaps what you're referring to there as well, about what's going on with those couriers and the people who are bringing packages to your door on behalf of Australia Post and elsewhere in the world. Well, in the UK, it seems to have been partly contributed to by the fact that we had Brexit, and then it became more difficult for, say, Polish truck drivers to come into the country. And what's happened here in Australia? Well, we don't have international students who might have been fulfilling some of those sort of gig economy or sort of more casualized roles. We don't have sort of all the people from Pacific Islands who are picking the fruit. And so a chunk of our economy is missing because we just can't access those sources of labor, I guess, that we have been able to historically. So at least that, to some extent, when the borders reopen, at least some of those issues should be at least mitigated to some extent, even if the overall sort of supply chain issues might take several years to mitigate and move through. So to give you an example on the shipping, so you might think, well, what happens when there's a lot of demand for ships? Well, the price for ships goes up. Okay, what happens when the price of something goes up? Well, people who supply that thing should supply more of it. So there should be more ships that are introduced. That's what should happen. However, building a ship is like building a building. You can't snap your fingers and get a new ship overnight. So the pipeline for ships, it might take a couple of years between ordering the ship and having it built, finance, getting it out on the ocean. So that sort of suggests that actually we're going to be some time away before even some of those ships that are now being demanded or are in the process of being built actually hit the water. So it might not be a short-lived thing in many respects.
In terms of like for investors, I suppose, like you sort of touched on before, there's some opportunities there. There's some that have sort of shipping companies that have really boomed in the last sort of little while. I think there's one in particular I want to highlight called Danaos. Is that what it's called?
I don't know how to pronounce it. But yeah, I know the one you're referring to. Yeah.
Yeah. So that's actually gone up from $3 to $75.
Yeah, I mean that's. Yeah, so 3 to 75. So I think if you invested 10,000 in that maybe 18 months ago, you'd now have $250,000. So Yeah, which shows you those. I mean, some of those businesses are quite leveraged. So they've got a lot of debt. They don't have much equity, or they're quite leveraged, so that suddenly if their profitability spikes, a business that was worth very little can suddenly be spitting out a lot of cash. And I guess part of why the share prices have gone up so much is that expectation is this won't be a short-lived thing. You won't be spending a lot of money in 2021, that actually, because that pipeline of ships coming through is going to be somewhat delayed, it's going to be 2022 and 2023. And if you look at some of the dynamics that are happening in the industry, it's not just that there's this spike of demand now for ships and a difficulty in getting them built. So from a shipbuilder's perspective, you've got some of these sort of environmental issues as well. So if I'm looking at building a ship, I've got to be pretty conscious of the fact that, well, ships today are mostly, they're mostly burning fossil fuels. And so where's the world going? Well, we're not going to be, hopefully we're going away from burning fossil fuels. So if I build a ship, if I order a ship now that comes in 2 years that I might then be using for 20 years, do I really want to commit tens of millions of dollars potentially on a ship over this period of time, which might then become redundant when some new technology or some new regulation hits? So there's another disincentive for investing in the supply of ships, which again boosts the profitability of the ships. And the other thing in shipping is, if you look back, I think it was mid 2000s, I think, when the last time we had a boom in shipping, what did the companies do back then? Oh, they built bucket loads of ships, right? Suddenly the market was flooded with ships. And what happens when the market's flooded with ships? Well, the value of those ships and the price that you can get for leasing those ships out to some of the liner companies just went through the floor. And so we've had this very long period of horrible profitability, of declining share prices. It's been a nightmare for the industry. And so anybody who's been in that industry has been burnt by that experience, is now going, oh gosh, we've got more ships being demanded. What should we do? Let's not do the same thing we just did sort of 15 years ago or whatever it was, and build a whole lot of ships and suddenly blow the industry up. Let's not do that. Let's just be a bit more careful. That's what they're saying, at least. Whether they actually then go through and follow through and actually exercise a bit more discipline, I guess time will tell.
It's interesting as well as sort of looking at the manufacturing side of things. There's obviously been disruption to those processes in the shorter term. I guess we can try and sort of project forward and look at whether, you know, that just-in-time process that we talk about, whether that will continue, or whether companies have potentially been burnt by the pandemic and all this disruption. How do you see that going?
Yeah, I mean, it really brings to the fore, doesn't it, a risk that perhaps was bubbling along in the background, but until this disruption has come, we haven't really had to worry about it so much, have we? So just in time, the idea that if I'm building a car and I need the engine, or I put the engine in just at the time, I get the engine delivered to the production line just at the time I need to insert it, and the engine, same thing, all the components, I get them just in time. So I don't have big stacks of inventory sitting around, which means I can have less capital employed in my business, which means the return on capital I get is higher, which means greater profitability for the capital, greater dividends, all that sort of stuff. So that's been great. But if there's been this inherent risk, which we haven't had to worry about, and now we actually do have to worry about it, say, you know what, just in time makes a lot of sense until we don't get it just in time. And now our production line is ground to halt because the engine isn't here, and the engine isn't here because this other component wasn't there, and that sort of thing. So what's the solution to that? Maybe it means we're maintaining more inventories. Maybe it means, which means more capital employed, more working capital, more debt, etc. So more cost and more capital, so lower overall short shareholder returns. Maybe it means that instead of having the most efficient supplier for a product, maybe, well, actually, I need to have two suppliers from different locations in case the ships from China are disrupted, but the ships from India are not, for example. So, and maybe that second supplier is just not quite as good on the quality, or maybe it's not quite as good on the price, or it's not quite as timely. And so the implication is I've got more capital, maybe the product's more expensive, maybe the quality is slightly lower. So none of those things sort of sounds good. I've reduced the risk of having to shut the whole thing down. So I guess it's almost like a form of insurance, isn't it? I've had to invest more capital in my business. I've had to lower my returns to defray this particular risk, which has just become very salient for everybody because we've just lived it. But if that means my product is lower quality or more expensive, and I've got more capital, am I making less money, or am I passing these things out to a consumer who gets a worse outcome for a higher price? So someone has to pay the piper here, whether it's the manufacturer themselves and therefore their shareholders. I guess we'll see how much that is passed on versus to what extent are consumers ending up having to foot the bill.
There's also a bit of a link here, isn't there, between this sort of global shipping crisis and what we've seen in terms of iron ore, from the demand for iron ore from China. So we know how much the Australian economy is to a large degree driven by resources. Can you see some implications there for Australian resources companies and by extension investors in what's happening with the iron ore price at the moment?
Yeah, so maybe I might just take a step back on the shipping side of things, because we talked about container ships previously, but there's three main segments of shipping, and one of them, so one is container ships. Another one is what they call dry bulk, which basically means these big ships that are sort of like a giant floating bucket that you tip iron ore, coal, wheat, maybe that sort of stuff into. And so there's this other segment. So the iron ore, the demand for iron ore, which has been, well, it's volatile. It went up a lot. And now it's just recently come back down. So to the extent that it goes up, well, we end up with more ships that are going out to China. They get disrupted at ports. So there's a connection with shipping in that, to the extent that we need more of these dry bulk freighters, that the value of those goes up. The other interesting one about iron ore is that what's iron ore used for? Well, it's used for making steel. What's steel used for? To some extent, steel is used for making ships. So, right, so they're not just sort of shipping the iron ore, they're made of the stuff that is iron ore is used for. And so if the price of iron ore goes up and the price of steel goes up, then it's more expensive than to build a ship. So, which is another barrier to building the ship. So fewer ships coming on. And the other interesting thing is, if I've got an old ship, then I can, my option is to scrap it and get the value of the scrap steel from it. So if the price of steel is high, then I could be sitting here going, you know what, it's better for me to scrap that old ship and get the scrap metal value from it, which again creates an incentive to get rid of the damn ship, which again pushes up the cost of shipping. So I think that the iron ore piece is quite sort of interplayed into some of the shipping dynamics, and some of the well, you can see in the shipping companies' share prices, perhaps not as good as the container versions, but they've done quite well as well. I think your question then was then going, well, what's the implication for Australia? Because I think shipping companies, I think there's a lot of them that seem to be based out of Greece and the US, but I'm not sure how many shipping companies we've got. Maritime Marine maybe is one, or shipping services related. Anyway, so your question about the implications for Australia, maybe what you're getting at there is the economic. You're talking the economics sort of side of things. Yeah, okay. So you're probably aware iron ore is the number one export for Australia. So it's fairly crucial from an economic perspective to the extent that we're building tax revenue is generated from exporting, and the earnings of companies like Fortescue and BHP is largely derived from exporting those commodities as well. So there's obviously significant implication for Australia if we can't get as much revenue from those sources. So then there's less revenue for the government, which means that we've got more debt, or we have to raise revenue from somewhere else. So anyway, so there's a bunch of things for the government. For companies, so Fortescue's and BHP's and Grange Resources and the others of the world who are producing iron ore, well, obviously they prefer if the iron ore price was high, and they've had a boom period in the last 6 months when it skyrocketed, and it's now come back down a bit. So there's been huge cash flows in that last sort of 6, 9, 12 months or whatever it's been since the iron ore price has been up. But if I'm a shareholder in those companies, what should I be thinking? It's less about what the price is right now, because frankly, it could be something quite different tomorrow and the day after that. It's going to be, what is the share, what is that the iron ore price going to be over the next 12 months and 24 months and thereafter? Because that's effectively, when I buy a share, I'm buying this set of future earnings. And so what do I think that's going to be? And that is a very difficult question to answer. I don't know if you watch the budget papers come out and they say, oh, well, we're going to make a budget deficit of, I don't know, it's a big number now, but it used to, historically much smaller numbers. It's $5 billion, for example. And it's based on the iron ore price of $87 a ton or something. And they've got no idea. And then the next, you get a budget update going, well, we said 87, it turned out to be 53. or 140 or something. They've got very little idea. Anyway, we as shareholders have to do the same thing if we're looking at a Fortescue or a BHP, perhaps to a less extent because it's more diversified. And how well do we do that? Not that well. So I'm always focused on the uncertainty inherent in that thing in investment decision making. And that one there, I think there's a fairly large inherent degree of uncertainty that makes it pretty difficult to then put your finger on where will this thing be in the future, and therefore what should the share price reflect.
It's interesting that we're seeing, particularly in Europe, energy stocks, coal, doing well, and it sort of seems a little bit counterintuitive to what we'd think, we're supposed to be moving towards. Renewable energy, seemingly. We've got the COP 26 at the moment going on in the UK. That spike in demand, there's a lot happening in Europe and China as well. What's your take on what's going on there and how that sort of relates to ESG investing?
Yeah, so for those that are not familiar, ESG here is environmental, social, and governance. So all the sort of good things beyond just earning money. I think there's a nice parallel, I think, between the shipping scenario we've just described and fossil fuels, which is if people are reluctant to build ships because they've been burnt in the past or because they're uncertain about what fuel to use and they don't want to build a ship that they can't use in 5 years, even though it's got a 20-year life. To me, it's the same thing or a very similar thing that's happening in energy markets, where do I want to, if I'm a conglomerate, like a BHP, for example, what do I want to do? Do I want to invest my capital in new coal mines? No, I don't. In fact, I think they've been divesting their coal assets. They don't want to do that at all. And broadly, that's a general theme from people who have an ESG bent to their investments is say, no, we don't want companies that we're investing in to be using their capital to be developing or even operating in many cases coal mines. And the same thing is happening for oil and perhaps to a lesser extent gas, because it's a little bit cleaner, but still has some emissions associated with it as well. So if that's the backdrop, the supply side has been, we don't want to invest equity capital, and frankly also debt capital. It's becoming increasingly difficult to get debt financing if you want to build a coal mine, for example, or even refinance the current debt on your coal mine. So what's happening is the supply side has been contracting. So look at the outlook for coal. I think it's the I forget the name of the International Energy Agency, I think it is, the projections for coal over time. And what do we see? Well, as you might expect, that coal demand is likely to drop off over the next, it's longer than you might expect. It's like 30 years or something. It might halve. Anyway, it's going down, but fairly slowly. So that's coal demand is going down, but coal supply is going down faster. So you end up with this sort of increasing or maintaining a gap between supply and demand over time. When you look at what coal mines are being developed, for example, and go, well, actually, even in the context of declining demand, if supply's demand is declining faster, then you're going to end up with this shortfall. And so what have we seen? It's not just developed markets. You look at China, for example, they closed down a whole lot of coal mines. Now you might say, is that because they think they're worried about the carbon dioxide? Possibly. I mean, a more cynical view would say, well, they're not actually that concerned about carbon dioxide. They're more concerned about the particulates, the smog that some of that sort of stuff was, the dirty coal was causing in some of their major cities. Anyway, either way, so they shut down plenty of coal mines. But meanwhile, they're building bucket loads of new coal-fired power stations. All right, so they, just in the one country, we've got this sort of supply-demand dynamic where it's easier to shut down the investment side. It's easy to reduce supply. But it's much harder to wean yourself off. Well, actually, you know what? I still like having relatively cheap and reliable power, which has been, I guess, the difficulty in China recently, where we've had, I think, a pretty cold winter, which has led to increased demand, and they've sort of had some supply issues. It hasn't helped that they haven't accepted Australian coal, of course. That's meant they've got to try and get coal from elsewhere. And there's a link to shipping again, because frankly, if you've got to go and get coal from somewhere further away, well, you're going to put it on a ship for longer. It's going to cost you more when it arrives there. So that's happening over in China. The UK and Europe is an interesting situation because it's not just coal, but it's an underinvestment in gas and gas pipeline to some extent across to Russia, but even things like the wind. So what's happened there? Well, we've got a large chunk of renewables in places like the UK that rely on the wind blowing, and the wind hasn't been blowing. I mean, it's sort of one of those things that people say it's renewables are fine when the sun shines, the wind blows, which is true to some extent. But in this case, we've had actually lower wind over in the UK, which has significantly reduced the amount of energy coming from some of those wind farms, right at the wrong time when you've sort of got these supply pressures around some of the old sort of fossil fuels. So I mean, the environmental pieces I think are quite fascinating because you've got this thing called global stilling. Have you come across global stilling? No,
I haven't. Explain that.
Well, I frankly can't explain it because I don't really know how it works. But I think what it refers to is the fact that climate change might result in changed wind patterns, and in fact, it might result in lower overall wind.
Okay.
I'm not a meteorologist, so I can't comment on whether that's the case, but I have seen that as one of the explanations. And similarly, an explanation for climate change can create some sort of polar vortex over the North Pole, which can then change wind patterns again, which can then create particularly cold northern winters, which then increase demand for energy, for heating, for example, which again, partnered with this sort of supply crunch, is leading to a crisis in parts of North America.
It's interesting as well. You mentioned that that sort of gap that exists that makes it easier to potentially stop investing in fossil fuel industry than it is to actually stop using them for the end consumer, and I suppose countries, states in general. So it could mean that fossil fuels they actually stay profitable for longer than we think, doesn't it?
Yeah, I mean, I think that's the case that we're seeing now. So it's not just profitability, but it's, I mean, substantial cash flows coming out of these businesses as well, because it's whilst, say, the oil price, which as we're recording this video is in the sort of between $80 and $90 a barrel, which is being quite high by historical standards, and the coal price is, I don't know, $230 US a ton. So whilst we've got those sort of elevated prices, which elevate revenues, at the same time, the companies in both oil and gas and coal, probably more so in the case of coal, but to some extent in both of them, are investing less in exploration and development. And so they've got less need for cash for building up those future supplies. So there's more than cash to pay down debt in many cases, or pay dividends, which is a good combination, I guess, to have as a shareholder. You tend to like companies that produce a lot of cash flow, but it's sort of a bit counterintuitive, as you're saying, because you're trying to invest with an ESG lens on it because you actually don't want these things to take place. No, we don't want coal companies to be making a lot of money. No, we don't want oil and gas to be successful. No, the idea is that it's the opposite. We're trying to withhold capital from these sources to try and prevent that taking place. However, if we really, as a society, if we really meant it, I guess would change the way we actually use the energy in that case, in which case those companies then wouldn't be as profitable. But it's, I mean, I quite like the parallel that's sometimes drawn between the fossil fuel industry and cigarettes. In that, well, in both cases, people tend to dislike investing in those things. In both cases, an ESG investor would say, no, I don't want to invest in cigarettes because of the harms they cause consumers. And no, I don't want to invest in fossil fuels because of the global environmental implications. But what happened with cigarettes? Well, when regulation said, actually, no, cigarette companies, you can no longer spend all this money on direct-to-consumer advertising, for example, it's obviously become stricter over time. But when they did that, what happened? Well, the companies then didn't have to spend all this money competing with each other, spending all this money on advertising, and they became much more profitable. So it was sort of like an unintended consequence, I guess, from good intentions flowing through. Again, it's sort of an uncertain environment, isn't it? You possibly make a regulation as a government, possibly you have an investment philosophy as an investor with good intentions, and then what happens? Well, actually, there's so many uncertainties and just sort of different offsetting effects in that process that sometimes these things turn out to be quite sort of counterintuitive.
So potentially, I suppose, like the cigarette smoker, we might still be addicted to cheap energy, maybe for a while to come, and until those, I suppose, the renewable sources start to come up and I guess prove themselves as part of that energy mix, that they can be reliable enough.
Yeah, although I think that there's a difference depending on which country you're talking about. So if you look at where are the coal-fired power stations being rolled out currently, I mean, there's big numbers in places like China, for example. And demand for coal, I think, it's more around Asia generally, versus how many we're building here, or how many in the UK, how many in Europe, for example, how many in the US. Well, that's not where they are. So I think as we perhaps in some of those developed countries look around and go, what the hell's going on here? We just saw on the news the other day blowing up Hazelwood coal-fired power station, and sort of seeing the big chimneys fall over. And well, I think the chimneys were historical, but anyway, so we're clearly moving away here. But meanwhile, we're shipping coal off to other places. Some developed, like China's still on the list, of course, but so sort of broadly around developing Asia, that's where the demand is, and that's expected to, yes, not be a growing segment of energy over time, but it's a long, slow decline. That's what's forecast based on sort of the life cycle of some of these power plants. So it's going to be with us for a while, you'd imagine.
Yeah, I saw it interesting that I think it was Xi Jinping was talking about the sort of emissions from China peaking around 2030, then dropping off towards net zero in 2060. Of course, it's difficult to actually say where those forecasts will be correct, but it just sort of highlights that they're continuing to be on that upward trajectory in terms of emissions and that energy use.
Yeah, there was a chart in The Guardian, maybe even yesterday, which showed China's historical carbon dioxide emissions, which over the last, maybe it was decade, was just this steep incline going up. And then they said, and all right, we get to current day, which is at this point at the top of the incline, and carbon projections, and it was this steep decline down. Just looking at going, oh, I'm not so sure that's going to take place to get back to sort of carbon neutral. So I think it might be 2060 maybe that they've said they would get to net zero emissions. Anyway, I guess we'll see. But certainly the projections from, I think it's the International Energy Agency, for ongoing use globally of fossil fuels, including the dirtiest versions like coal. Yeah, actually, I should say as well, by the way, I mean, there's a distinction here to be drawn between thermal coal, the stuff that we're probably talking about in terms of electricity generation, versus coking coal or metallurgic coal, the type that's then used for steel production. So even if we do move away from power generation, we still have the problem of what are we going to do for converting iron ore into steel. And so there still could be a component that's used for that, even if we can move away from an energy, from electricity generation perspective.
Interestingly, today in the news, I saw on the ABC had an article talking about the dangers of stagflation. So a bit of a throwback, I guess, to what we think of that happened in the 70s. So they were pointing to the increases of prices for cars, property, as we've talked about, oil, coal, and gas, and that's feeding back into the supply chain. Meanwhile, they talk about global growth still, not firing along too quickly as it could be. What's your thoughts on that in terms of stagflation? How much it could be a risk, or is this more speculation than anything?
Good question. I mean, my general philosophy is stay away from economic forecast, because I'm just aware of the research around the efficacy of making a forecast around various economic variables, and it's like throwing darts at a dartboard, or a blind monkey throwing darts at a dartboard. So, but if we stick less, I mean, perhaps focus less on the sort of the speculation of the future and more on what's happening today, and say, well, is some of this stuff already starting to sort of percolate through? And I think, if I recall correctly, it was a possibly a 2.1% CPI number that came out headline number, I think came out in the last day or so recently, which I think now is at the bottom end of the Reserve Bank of Australia's inflation range. So yes, it does look like inflation is picking up. So the parts we need for stagflation are the stagnation, so lack of growth, and inflation. So is there inflation? Okay, so there's some semblance of it. It's not high, but it's gone up a bit. And yes, I agree with you. There's a bunch of things that might be driving it up. Yes, energy prices are rising. Yes, property prices are rising, although rents aren't really rising that much, at least not in major capital cities, or at least places like Melbourne, for example. So yes, we've got some things going up, but we've also got a backdrop of stuff that continues to go down. So all the technology-related stuff, and continued innovation. Your computer's not going to cost you more tomorrow than it did yesterday, for example. So that's, I guess, broadly a backdrop of some of those other things are continuing to fall. And overall, what have we got? We've got a little bit. All right, so maybe we could make a case for the inflation piece. But then the other half of it is to say, but what about growth? We need growth to be low or nothing to get the other half of the stagflation equation to take place. And certainly in Australia, I mean, we're coming out of, well, as we speak today, I'm still not allowed to visit a shop, for example. All right, so we haven't quite come out of lockdown properly yet in this case. So how much have we got of recovery of actually getting back to closer to a normal environment where we can actually go back and spend things on the services, to go travel overseas, or even into regional parts of Victoria in my underprivileged state. And I think, I mean, globally, other countries are probably a little bit further down the track than we are in relation to that. So perhaps the global picture is a little bit different. In Australia, it's what without wanting to be an economist and try to forecast where we're going, but at least we've got a bit of that sort of reopening piece to come. But generally speaking, I mean, looking back on say the 70s, where you referred to the issue of stagflation occurring previously, we have less of a problem, I think, of things like energy prices or oil prices translating into poor economic growth, just because there is much less of a connection. There is much less oil required per unit of GDP now than there was all the way back then. So a supply shock, if it's an energy supply shock, for example, it shouldn't affect professional services, for example, people sitting at home on their Zoom calls. The fact that their tank of petrol now costs them $20 extra while they're sitting at home doing their Zoom call shouldn't make any difference at all. What's going to impact them is the price of computers and how much they're paying for their NBN. And I mean, to some extent, they're paying for lights and things as well. That's true, but it's that connection is less now than it was historically. So without wanting to be the economist, I'm less concerned perhaps than that stagflation scenario perhaps might paint.
As we sort of wrap up our discussion here, if we bring it back to, I guess what it all means for investors, I suppose we have this narrative about fossil fuels being on the decline, that they're bad, like we talked about, and although, as we say, that that could be true from an ethical or social point of view, it doesn't necessarily mean that they're a bad investment, does it?
Not necessarily. I mean, time will tell, I guess, as to see what takes place from here. But certainly as we stand today and looking back over the last 12, 18 months, maybe, investing in coal and oil and gas has been a very profitable sort of side of investing to be in. Now, having said that, it has been pretty unprofitable for probably the 10 years prior to that, which I think just paints the picture that investing is inherently uncertain. So we don't really know what's going to happen. We don't know what's going to happen with the iron ore price. We really don't know what's going to happen economically. And with ESG, I think that's a good environmental sort of investing and some of the narratives that go with it. I think that's a good case in point to say we probably need to look a little bit deeper through what I would call a causal narrative, a story about how something causes something and something causes something else. Because frankly, when you get complex and inherently uncertain and complex systems like an economy or like a business, for example, it is very difficult to get a causal narrative. Like, it's not like fixing a car where you can go, this joins to that, and if I press this and that, it's not like that. It's just so difficult to predict. And so what I would, I guess, suggest, if someone's trying to draw a conclusion from an investment perspective across some of the things we've just been talking about today, it's perhaps to rely less on some of those narratives, or at least challenge the narratives with that level of inherent uncertainty and say, yes, but what else might happen? Or what if I go and look a little bit deeper, and is it really what I might expect? Because I mean, if you today went away and said, what did I learn from this session? Oh, I know shipping's a good place to be, or has been. Well, what about tankers? Tankers that are shipping oil actually has not been a good place to invest at all. So even that, all right, even if you listen to the narratives we've got today, I think you still might come away and go, oh, I was surprised by that. So perhaps that's the main lesson here. Take those narratives with a grain of salt, think about the inherent uncertainty, and maybe look a little bit deeper.
Well, great. Thank you, Simon, today for all your insights. It's been great to chat with you.
Thank you very much. Appreciate your time.